Hi everyone, I'm Kara Carlson, your host for today's webinar, Relationships Not Robots. Joining me is Arthur Lines, the Senior Investment Officer for AAFMAA Wealth Management and Trust. We have about 30 minutes of slides for you today, and then we'll leave plenty of time for your questions. Since you are muted, please ask your questions by typing them into the questions block on your screen. This monthly webinar series is brought to you by AAFMAA Wealth Management and Trust. We are AAFMAA's trust company. AAFMAA stands for American Armed Forces Mutual Aid Association and is the longest-standing not-for-profit association that empowers military families with affordable financial solutions. We accomplish this by being the premier provider of financial planning, investment management, and trust services for the military, not-for-profit. Also, as a trust company, we have an additional legal obligation to act as your fiduciary, which means we only act in your best interest and for your benefit. Here's an important disclaimer. This presentation is educational, it is for general information only, and is not specific investment, legal, or tax advice for any of you individually. Do not rely on this presentation alone to guide your financial planning decisions. Since each individual situation is unique, your needs for financial services will differ. For individual advice, please contact us directly. We produce this webinar series in-house with our own professional staff as a service to our members and to help them better understand the resources that are available to them. In this case, today's presentation on personalized investment management will focus on showing you a behind-the-scenes look on how a professional investment manager operates. So I will now go ahead and turn it over to Arthur to go over the agenda, and we'll be back at the end for questions and answers.
Thank you, Kara. Good morning, everyone. There are five main areas that I wanted to touch on this morning. First is a history and a definition, if you will, of the investment management business itself, and then move into the investment management process and what that looks like in terms of how a firm will actually invest portfolios, what the team member responsibilities are and how they interact with each other and how they interact with clients. Then look at a couple of industry developments that have occurred in recent years, and finally maybe a few tips on selecting your own personal investment manager. So with that, let's begin by looking at what is the investment management business. You know, there's a lot of terms that are thrown around today, so oftentimes it's very easy to get them confused or convoluted in some way or another. But what I'm referring to, investment management, actually started about a century ago. In the early 1920s, you had a number of very large, wealthy families, Rockefellers, the Morgans, the Carnegies, that were out there trying to hire an experienced professional manager for their portfolios so that they could spend more time managing their businesses. So that was one of the dynamics that was going on. The other dynamic that was going on is that as the stock market was starting to improve in the 1920s, there were a lot of small investors that wanted to participate in that. They wanted to grow their own wealth, and a lot of investment pools, pooled type funds, which we now refer to as mutual funds, they began in the 1920s. And so you would have professional managers running these investment pools on behalf of small investors. And so in these situations, clients will pay a fee generally based on the a percentage of assets under management. They'll pay that fee to the investment professional. Then in 1974, there was a law that was passed called ERISA, which is an acronym for the Employee Retirement Income Security Act of 1974, and it brought all these pensions, primarily at that time they were defined benefit plans, brought them on board with the fiduciary standard of care. And so what would happen is that you would have, let's say, the owner of a business or a board of trustees of a large corporation that were responsible for managing the company pension plan, now they were held to the same standard of care and management and professionalism as an investment professional was. And so that's when a lot of these plans started hiring investment managers to run their pension plans. And so ERISA really made the investment management business even more necessary. So, you know, when we're talking about an investment manager, we don't want to confuse it with a broker. I know the terms investment advisors and financial professionals and all these types of terms are thrown around, but let's not confuse it with a broker, a financial planner, or an insurance agent, because they can also potentially charge commissions in addition to fees. Some investment people are only charging commissions, some are only charging fees, but some can charge fee and commission. So the question that's been asked to me 100 times is, well, how do you know? How do you sort that out? Very simply, you can ask that person whether or not they have a securities license. Do they have either a Series 6 or a Series 7 securities license? And if they do, then they can also charge commissions in addition to fees. But generally, investment managers, the kind that I'm referring to, are governed by the Investment Advisory Act or the Investment Company Act of 1940. So that's kind of a brief overview of that business. Now, if you look also, there are, on the next slide here, there are also banks and trust companies that manage assets too. And AAFMAA Wealth Management and Trust, as the name implies, we are a trust company. We can act in a fee-only investment management capacity. We can only act in a fee-only capacity because we are not brokers. We are not affiliated with a broker-dealer. We are not a securities firm. You know, if someone calls us up and wants to place an order to buy a particular stock on their behalf, we cannot do that. That's not what we do. We can't charge commissions. And we're going to be regulated by either federal or state banking authorities. That's how banks and trust companies work. They're going to be regulated by the banking side of the world, and other broker-dealers are going to be regulated by, for example, the Securities and Exchange Commission. Now, banks and trust companies, though, we are always held to the fiduciary standard of client care, and you might have heard Kara mention that a minute ago. That is the highest legal standard for taking care of a client's investment portfolio. It means we have to put their benefit ahead of our own in every single case, and manage their funds as we would our own in the most prudent manner possible. So investment management and trust companies earn fee income by serving the clients that have entrusted them with their investments. That, very simply, is the investment management business. So how does an investment manager operate? Well, there's a lot of firms out there. They're big, some very, very big investment firms, very small firms, and everything in between. But the focus generally is what we call the 3 Ps. We're going to focus on the investment philosophy, then the investment process, and then the people that work for that organization. So even though I've worked with a number of investment firms, I'm going to use AAFMAA Wealth Management and Trust as the example for the behind-the-scenes look at an investment manager. So let's begin now with the investment philosophy. The investment philosophy are kind of those driving foundational principles that any investment firm would use to form the basis of how they invest money. Now, for AAFMAA Wealth Management, these happen to be the 4 parts of our investment philosophy. There's a lot of different philosophies out there, but this is ours, and we feel that it's time tested. It's based on long-term historical observations over decades and decades of work, not only from practical experience, but in the world of academia as well. So first is the fact that we believe that long-term investing produces better results than market timing. It's very difficult to time the market, even just a little bit, because you have to make, number one, you have to make twice as many decisions. You have to know when to get out and when to get in, when to get back in. And so for many people, and we've seen this over the years, they may have called one part of that equation correctly and gotten everybody out, but they never got back in and missed out on the corresponding rise in the market. So we believe that long-term investing is going to work much better. The second part is matching asset allocation to an investor's profile is critically important. Now, asset allocation is that term that we use in our industry, where we try to determine how much of somebody's assets goes into stocks, bonds, alternative investments, precious metals, real estate, whatever that asset class might happen to be. And it's based on the investor profile, which means that it's very, very important for the client to give us a complete look of not only what their financial condition is like, but also what their emotional and investor type personal profile is like, because this all goes to the heart of risk management. You know, I've told so many people that we really don't have much control over what types of investment returns, you know, how much the market is going to pay us. We don't really have a lot of control over that. But what we do have control over is how we can manage risk, and so that's critically important. Thirdly, and along with the risk management idea, is that diversification among various asset classes reduces risk, and that's why you'll see in most of our portfolio anywhere from 6 to 10 different asset classes that comprise most of our portfolios. And finally, investor behavior is an important determinant in portfolio returns. And at this point, I want to reference some of our previous webinars. I've given 2 webinars in days past. They're archived. They're on our website, and I would encourage you to listen to those if you haven't already, because how an investor acts or reacts is going to be a key driver in how well and how successful they are in their investment returns. So that is our 4-part investment philosophy. You know, every firm has a different philosophy to some degree, but this is ours. We're very comfortable with it. Like I said, it's very time tested, and we feel like it's done our clients good. So let's move on now to the investment process. The investment process is also sometimes referred to as the investment discipline. So how does AAFMAA Wealth Management and Trust make investment decisions? Now, the great thing about the U.S. capital markets is that there's a lot of ways to make money. There's also a lot of ways to lose money, but there's a lot of ways to make money. And so I don't want to say that this is the only way that an investor can be successful, because that's not true. But at the same time, not every company's approach and every company's investment discipline is suitable for a client or an investor. But this is what we do, and it begins really with the big picture view of the economy. This is called a top-down approach. We're going to look at we're going to analyze the economic data. We're going to look at what the Federal Reserve Board is doing. So that's called monetary policy. We're also going to look at the government deficit, how the government's spending money. That's called fiscal policy, and try to draw a big picture view of the economy. In other words, is it growing? Is it stagnant? Is it contracting? And a more full discussion of that would be found again on some of our past webinars. This past year we had a beginning of the year market outlook, and then we've also had a mid-year market outlook, and we discussed that in detail. So this top-down approach, we start to analyze the data and draw conclusions, and then start to connect the dots in terms of what does this mean in terms of asset allocation and the sectors of the market that we should be in or be out of based on all of this economic analysis. And so we began to develop our asset allocation models. So how much should go into stock, bonds, cash, various types of stock, international versus domestic. And we have 7 different models based on a client's risk tolerance and suitability for them. So we can be very aggressive, we can be very conservative, and we can be, just about everything in between. So 7 different models, again, based on risk. So at this point, receiving input from the client on risk and other factors such as, do they need distributions, or are they in an accumulation phase in their life? Do they have long-term care situation, retire, all types of factors, in addition to what are they comfortable with, how have they acted in the past when they've invested. All of these types of factors go into this large discussion on client input concerning risk and risk management. And then we know at that point which asset allocation model is going to be the most appropriate and the most suitable for the client. Then we structure the portfolio and select the securities. So you'll see any given portfolio will be invested either in individual stocks sometimes, or ETFs, exchange traded funds, or mutual funds. And then once that has been selected and input into the portfolio, we're going to continuously monitor and continuously do our research, not only on those securities, but part of the monitoring process is also the fact that we have 2 5-person committees. One's called the Investment Policy Committee, which is responsible strictly for the investment side of the equation. The other is called the Account Review Committee, and it's their job to make sure that every account has the proper documentation, and that every account is adhering to the guidelines that the client has dictated to us in accordance with their desires. So there's a lot of people involved in this investment process, and it keeps us focused, and it keeps us very objective. Now the third P is going to be people. And in the context of that, first we've got 3 components: a corporate infrastructure, experienced professionals, and inside-outside culture. So with a corporate infrastructure, that's where the firm has to make sure that it has the proper amount of research capabilities, that we can get our hands on any type of information about any security at any point in time, and we do have those types of capabilities here. Trading platforms, being able to trade our client accounts and make the adjustments that we need to make on every one of our portfolios in a very time-efficient manner is critical. Also, this will include administrative and record-keeping functions, and do we have the platform and the systems to do that? And of course, these are all givens. You would expect an investment firm to have this type of infrastructure. Next will be the experienced professionals. It's been said that the investment management business is the only business where assets of the firm drive their cars home every night. We don't have large department stores with, filled with stuff, filled with inventory. We don't have huge manufacturing plants, like the steel industry or the automotive industry. So it's very unique in the fact that our most valuable asset are the professionals that work at our firm. And with our firm, our key professionals average over 25 years of experience in the industry. We have a very highly credentialed organization among all the folks that work here, maybe even on a per capita basis, maybe even more so than most firms that are out there, because we know that experienced professionals make the difference in terms of not just performance, but in terms of a favorable client experience. And then finally, there's something that I refer to as the inside-outside culture. The inside culture is the firm itself and how it treats its employees, and also how those employees interact with each other. So it's very important that the firm have a team approach, that their teamwork is very solid, that they have a spirit of collaboration. And so that's why with us it's not unusual to see 2, 3, 4 people involved at any given time in the client process and in working with the clients. And most of you know, if you're an AAFMAA member, you're familiar with the AAFMAA culture, the idea that we're a nonprofit organization, that was developed just for the military back in 1879 to take care of the military and their families. So that is a cultural dynamic that is unlike any other firm out there, in terms of what we do, who we serve, and how we serve them. Now, the outside culture means then that it's important to not only be concerned about the firm and how the firm is operating inside, but are we responsive and are we accommodative to the client? Many investment management firms, unfortunately, are not. They're kind of a one-size-fits-all, this is it, take it or leave it kind of an approach. Whereas with our firm, as I said, we've got 7 different asset allocation models based on where you, the client, are in terms of risk. For example, we have a number of clients that have put constraints on us, saying that maybe they didn't want to be invested in international, for example, or they only wanted 40% maximum in the stock portion of their portfolio, or some of them want to receive a check for $2,000 a month, for example, out of their portfolio. Whatever it may happen to be, it's so important to have this outside culture that's responsive and accommodative to the client. So those are the 3 P's: philosophy, process, and people. So now let's look at, do we want to go to essentially a big box firm or a boutique firm? Or sometimes I also call it a department store or the boutique. There's some investment managers out there that are managing right at $1 trillion. I think there's 5 of them that are managing very close or more than $1 trillion in assets. It's hard to believe, because I remember the days when $1 billion firm was considered to be a huge firm, but now we're looking at multi-hundred billion and trillion-dollar firms. And so you're kind of looking at this and going, okay, do I want some of the services, or do I of a big box firm, or do I want kind of that name, or do I want to go to a boutique where people know me, know who I am, call me by name, understand me pretty well? Well, if you kind of line this up, and with a big box firm, they typically have a higher employee turnover. I mean, if you think about it, if I'm an investment professional and I'm working in a firm of 500 people, working in a firm of 1,000, 2,000 people, which is not unusual, my results, my recognition is not going to be nearly as great or significant as if I'm with a smaller firm with a dozen people. So for me personally, I can make my mark on this firm far easier than I could if I was with a big box firm. Also, with a very large firm, it's just harder to reach people. It's harder to get in touch with them. If you want to talk to the portfolio manager, good luck. That will not happen unless you are a client that has $100 million or more. Unless you are a very, very large client, you will not get to talk to the portfolio manager. Whereas here, you can pick up the phone and speak with me, speak with Rick Convey, and almost anybody else in our firm, and we're happy to give you our direct number so that you can make that contact. So with a department store firm, they have a large number of clients. That reduces the client interaction. And along those lines, $5 million and up clients get the personal service. Smaller clients get very little, if any. Listen, there's a number of firms where the minimum account size is $10 million. There's a bond manager that I know of where their minimum account size is $50 million. And so that's what I mean. You have to have in the tens of millions to get personal service, to get that recognition, to get the amount of interaction, even if they'll take your account. So, you know, again, with a boutique firm, we're very responsive, we're very accessible, we're continually focused on a positive client experience, and all of our clients receive as much attention and service as they want. So, for example, we have some clients that I've never met with. They don't feel the need to meet with me. They're fine receiving you know, their monthly statements and an annual report, and they're fine with that. Other clients do talk with me on an ongoing basis, and they'll ask me questions about the portfolio, or they'll be in touch with their relationship manager on a regular basis, or their account administrator. All of these folks are going to be in touch with them, and they get as much service and attention as they desire. Which kind of leads me then into the next point. Who is on the client's team? Well, we have three major categories at our firm. First is the relationship manager. I'm sure if you've spoken with either Kerry Clark or Ross Cutler, then you've already been in touch with one of the relationship managers, and they work directly with the clients to try to understand their needs, assess their level of risk and their comfort with risk, try to identify the right solutions for that particular client. And then you know, at some point they'll bring me in as the investment officer, you know, maybe before they're a client, and we have more discussions together about risk and about returns. But then once they become a client, then it's up to me to kind of build and manage the investment portfolio according to their guidelines and according, you know, what falls out of all of the discussion, and we'll manage it according to the client guidelines. And then last but not least, certainly, is the account administrator. The account administrator takes care of a lot of the day-to-day administrative issues, tax issues. You know, they're making regular contact and communication with the clients. You know, they may be, let's say they sit in on the investment policy committee meeting, for example, and they'll convey some of that information to the clients, or they'll be responsive to whatever the client is needing or wanting at that particular time with their account. So those three are on the client's team. And so on the next slide here, when you look at the client team, first and foremost, client input is essential because investor behavior has a significant impact on the returns. And again, I will reference you back to the two webinars that I gave on investor behavior. They're archived under Wealth AAFMAA.com. I'll give that to you again later on. But it's important, it is critically important to stay objective in the face of market stress. And so when you have a client team working with the client, it's easier to stay objective. So, you know, you look at this relationship manager, they're communicating with the client, they're assessing risk, they're reassessing risk on an ongoing basis. You know, that relationship manager is an important point of contact if there's a change in the financial situation or change in the life situation. Just as it is with the account administrator. The account administrator is responsible for ongoing communication with the client as well. And so if the client has a change in the financial situation or their life situation, they need to communicate that with the account administrator. But the account administrator is also very proactive with the client in trying to determine this information so that they can ultimately pass it off to me, the investment officer. So I'm going to be managing the portfolio according to the investment discipline. And it's this investment discipline that keeps us from making emotional, short-sighted decisions. So for example, when things were really declining in December, January, February of this year, the investment discipline not only kept us invested, but as the market was declining, we were actually, in many cases, able to rebalance the portfolios and purchase more securities for our clients, which turned out to be an absolutely terrific move because the market did rebound, and you know, it's given us a great performance this year. But you know, we can only do this in light of having this team approach, in light of having this investment discipline. And for those clients that were becoming a little more emotional, I was talking to some of them, so was the relationship manager, so was the account administrator. Everybody was staying the course, and so it really had a significant positive impact on the client portfolios for this year. Now, all of that being said, there's really, I'm noticing two disturbing trends in the investment management industry. First is this idea of a robotic, or it's typically known as a robo-advisor, which uses algorithms to allocate and manage client portfolios. Now, there's nothing inherently wrong about a computer algorithm, although I will tell you I have seen some absolutely crazy algorithms that have had horrendous results for clients, and I won't spend the time to reference all of those examples, but there have been far too many. But even a regular middle-of-the-road algorithm, if you will, you know, it raises a lot of questions. I mean, how well does a robo-advisor know their client? Well, they don't know them very well because they have them generally complete a one-page questionnaire, fill out 3 questions, 4 questions, and that's it. And then they're going to put the square peg in the round hole whether it wants to go there or not. You know, so can they customize portfolio construction? Absolutely not. But, you know, the robo-advisors have started up only a few years ago, so we really don't know what will they tell their clients, or what will they do for their clients, or how will they walk with their clients when things are chaotic in the market. You know, when you get an 18 to 24 month bear market in which there's a 20 to 25% decline, we haven't been through one of those in you know, in a number of years, and so we don't know what the robo-advisors will do, and so it's really unclear as to how they're going to be able to dampen the emotional responses that clients sometimes have. And at the end of the day, will they add value to the investment process and to the client servicing process? Well, that remains to be seen. I suspect not, but that does remain to be seen. The second trend that I find a little bit disturbing perhaps even more so, is the fact that these larger managers, and I mentioned that there's many now that are in the hundreds of billions of dollars, they're getting rid of their smaller clients. Or they're not spending the time with them, or they're outsourcing that relationship to either a junior person. When I mean a junior person, I'm talking about somebody with 1 to 3 years experience in the investment management industry, or even a call center, which would probably have a junior type person. And so really all the larger firms are trying to do is really to increase their profitability from the smaller individual clients. They really don't care about client servicing. They really don't care about servicing them and doing a good job for them in general. And so, you know, my question is, how is this going to impact portfolio returns for these clients? How are they going to be able to navigate stressful markets? You know, what effect is this going to have potentially on their retirement income? And so I see that as a disturbing trend, because investment managers at the heart of things we exist to serve our clients. And when larger firms no longer want to serve their clients, I find that very disturbing. So here's some tips, excuse me. So here's some tips in terms of working with your investment firm. Some of you listening may have already had an investment manager. Some of you may have never hired an investment manager before, but I would encourage you to ask these questions regardless of where you are in the process. First of all, do you understand and believe their investment philosophy? You know, as I mentioned, there's a lot of ways to make money in the market, but it's important that you understand and believe that that philosophy makes sense to you. Frankly, this is the foundation. If the philosophy doesn't make sense, if you don't understand the investment philosophy, it's kind of a red flag, because either they can't explain their philosophy well, or there's something kind of not right about it, which also goes along with the investment process. Is it understandable? Does it make sense? Are you comfortable with it? Because if a manager cannot articulate their investment philosophy, something's not right. They should be able to very clearly articulate their investment philosophy, and it should be understandable. If it becomes too complex, that's also a red flag as well. If it seems too good to be true, that's going to be a red flag as well. And so you have to have a comfort level with it, and it has to make sense to you. Also, then, how much input did you have into the process? Are you going to be able to put some constraints on your manager? Did you have a very long discussion about some very deep details about your feelings on risk and your feelings about your financial situation? Or did you just, you know, fill out a one-page questionnaire and that was it? Then, can you trust their people? Who are their people? Can you trust them? And then finally, is the firm client-centered in how they interact? And you'll get an idea of that as you go through the initial process of understanding their philosophy, their process, getting to know their people, and also if you've had significant input into the process, chances are they're a client-centered firm in terms of how they interact. So with AAFMAA Wealth Management and Trust, we're going to encourage you to connect with us. We offer some complimentary services at no cost. First is a financial dashboard. It's a web-based program that allows people to organize and to track their investments and their household assets. It's a great tool for many of our clients. Also, we offer a complimentary portfolio review, and this will help improve your risk management, kind of give you an objective second set of eyes, if you will, on your portfolio. We're going to examine everything primarily from the standpoint of risk and risk-adjusted returns. Thirdly, you've heard me mention many times already about the educational webinars that are available. They're archived at wealth.afma.com, and I would encourage you to peruse those and listen to them. We have them on a variety of topics. We've been doing it once a month now for 3 years. So if you're interested in any of these services, you can email us at wealthmanagement@afma.com. You can call our general number at 703-707-8020. We'd love to hear from you. We love to work with you, and we love to help our members and our clients. And so with that, Kara, I'm going to stop, see if there's any questions, and we'll go from there.
Great. Thanks, Arthur. So now, everyone, what are your questions for Arthur? We've collected a few questions already, but please don't hesitate to ask others by typing them into the questions block on your screen. As a senior investment officer, Arthur is responsible for generating investment ideas and investing client portfolios. So I'll go ahead and leave his contact information displayed here while we go through the questions and answers. All right, first question. I'm going on 70 and have an IRA with Edward Jones and an annuity. Any savings ideas for me?
Well, it's really difficult for me to answer that question without knowing a lot more about who you are and what you need to accomplish, not only financially, but what your past investment experience has been. I will say, just in a broad brushstroke, because interest rates are so incredibly low, it's made savings and investing very, very difficult for people that are 70 and up. And so, we have to look at alternatives, but we also have to look at alternatives through the prism of risk. And that is a very, very large part of the discussion that we have with anyone that we come in contact with. So I can't really offer you anything specific without knowing who you are. I would encourage you to contact us, and let's have that discussion specifically offline. Yeah, we all, at that standpoint, we all have to be very careful of risk at this point in the game.
Great, thanks. Next question. How many client relationships should a manager have to provide good service?
Well, I would say in general terms, probably 100, maybe 200 relationships. That not only the investment officer but also the account administrator can handle. Some of it is going to depend on how much service each client is needing. But in general terms, probably about 100, 150, 200, it would be definitely at the top end. And we're not there yet, so we've got plenty of capacity to continue to serve our clients, for those of you that are listening and wondering about that.
Great, thanks. Next question. Why do you think people would want to hire a robo-advisor?
Well, I think the only reason why someone would hire a robo-advisor is because the fees are so low. And the reason why the fees are so low is because there's no human contact. Everything is done by computer. The algorithm is generated, the questionnaire comes in, and then a computer makes the allocation decisions and invest the money. So there's very little, if any, human interaction, and so the fees are very low. And again, there are a number of times, generally during times of great stress, when you have to have that human interaction, and you have to have someone on the other end of the phone or on the other side of the table that can answer your questions and kind of walk with you through times of stress. So I think really just the low fees is the only reason.
Okay, thanks. Another good question. What size account do larger investment managers want to have?
Well, again, that's going to depend on the firm. I mean, I've seen, it's not unusual to see $1 million minimum for the some of the bigger firms, they're at 10 million. I know some at 50 million. I mean, you know, it's kind of a business decision for each firm in terms of the types of clients that they want to deal with and the size of clients. Now, for us, you know, we have a very unusual structure because we serve only the military. We don't serve large institutions. You know, we don't serve typically. You know, we're not going to deal with corporate executives, you know, that have $100 million in stock options. We're dealing with military and even retired military, and so our minimum account size is, you know, is much lower. You know, for the most part, it's at $100,000. Although we have taken client accounts that were lower than that, because we knew that it was important for their situation that we served them, and based on their situation, we've made those judgments. So we're going to have a very different profile than most of the other managers that are out there, and be a lot more willing to serve them and to be accommodative.
Great, thanks, Arthur. And thanks to everyone for asking questions. If we didn't fully answer your question, or if you think of another question later, please reach out to us at wealthmanagement@afma.com. We'll go ahead and break here for now, but you can reach us whenever you need to. Please don't hesitate to ask for help. This is what we do, and we love it. This weekend, you'll receive a follow-up email with instructions on how to access a recording of this presentation. And you can always sign up for future webinars or review past webinars at wealth.afma.com. If you found this information useful, please share it with your family and friends. Our membership grows stronger every year because you introduce your eligible friends to AAFMAA. We hope you'll join us again for our next webinar. Thanks so much, everyone. Have a great day.